If I were a young buyer at the moment, I would, as I've been saying for quite some time, be looking through the lengthening list of properties available for sale and looking to do a bit of picking and choosing and throw some offers in there. Well, hello again, everybody. Just a few days ago, we saw REINZ release their latest data on the state of the housing market all around New Zealand. And basically, the numbers look fairly similar to the month of June. These ones were for July. And what they show is that on average, it's taking about 16 days longer to sell a dwelling anywhere on average around New Zealand now than was the case a year ago. So definitely the market slowed down by that measure. The volume of sales, so the number of properties sold in the month, was down about 37% from a year earlier. So undoubtedly there's probably a few real estate agents out there looking for some other income sources at the moment. Given the tight labour market, they shouldn't have any problem finding a job doing practically anything else at the moment. We've also seen prices go down on average by 1.4% in the month of July. That means they have now fallen on average for the country as a whole 10.4% from that absolute silly peak back in November last year. Auckland prices on average have gone down about 16%, Wellington's about 14%, Canterbury, the whole region about 4% lower. Queenstown is actually 3% higher, but that's the only of the regions that I follow which has actually shown an annual increase. And of course that's because of the return of the international tourists, those in there so far, and the extra numbers expected to come down, of course, once summer comes along. So look, basically the housing market is still weak out there, but as I was saying in my video from last week and maybe even the past 2 to 3 weeks, I can see some early seeds of improvement being sown, but for most of the next few months, these numbers are still going to be fairly negative. Prices are going to fall earlier, but I've taken to writing in my columns and my weekly publication, Tony's View, that maybe first home buyers should increasingly be challenged as to what exactly is it you are after. Are you looking for a home in which to raise a family, in which case taking advantage of a 104% increase in listings from a year earlier and a 10.4% average fall in prices would probably be a good idea? Or are you trying to eke out the last 5% of the fall in average prices in your region? Keeping in mind that whenever you've heard your parents, grandparents, anybody you know talk about the value of their house now and what it was when they bought it 5, 10, 50 years ago, the 5% difference is completely lost in the wash. It is totally meaningless. And for people like myself, I know that we cannot pick the tops and the cycles, the level at which prices get to, or the timing of it, and the same for the bottom as well. So, personally speaking, if I were a young buyer at the moment, I would, as I've been saying for quite some time, be looking through the lengthening list of properties available for sale and looking to do a bit of picking and choosing and throw some offers in there. The other thing I just wanted to note at the moment is that banks are increasingly cutting their fixed mortgage rates. Nothing major, no slashing by 1% or anything like that, but there are some pressures coming in play there. Number one, the cost to banks of borrowing money to lend out has actually gone down about 0.7% from where it was back in June. That's in the wholesale markets, and those rates they reflect expectations of monetary policy in the future, the next 1, 3, 5 years, rather than what the Reserve Bank's official cash rate is doing at the moment. That's a little bit of a red herring for what the fixed rates are doing. I think some of the banks are probably starting to feel their cashback offers are getting a bit expensive, so they'll be wanting to switch back to discounting some of the fixed lending rates. Deposit rates haven't gone up as much as lending rates, so there has been a bit of margin improvement overall for the banks. We've also seen a few media items about non-bank lenders getting larger, more and more people going to them. And, think in terms of, say, Air New Zealand, when a new airline opens up and wants to run a few of the regional routes, there is a change in pricing structure from Air New Zealand to compete against that. And I just wonder, with the non-banks getting larger now, if maybe some of the banks are not looking to front foot it and try and prevent so much business from going towards them. And also, we've just got to keep in mind that there are a lot of people who took the candy last year. you fixed for 1 year at 2.19 or 2.49%, and now your rate is rolling into something higher, there are going to be more people looking around for who can offer them the most attractive refixing rate now than we will have seen for a great number of years in this country. So banks are looking to protect their existing client base with some of those discounts in the fixed rates. Like I say, I think the fixed rates did peak back in the middle of June. I think there are some more decreases coming, but maybe we've just seen the bulk of what the reasonable moves could be for this year over the past couple of months. But hey, anything's possible in this strange world we continue to live through. All the best out there.